But then the question for me becomes, as we embark on a rate lowering cycle, where is that terminal lower rate likely to be? In other words, how much higher is it likely to be than we've become accustomed to for interest rates?
So as far as the market pricing is concerned, the pendulum has completely swung the other way. Coming into this year, we were expecting perhaps a terminal Fed funds rate in and around the long run rate of 2.5%. But the market's saying that that terminal Fed funds rate should be perhaps above 4%, maybe even above 4.5%. So that's a very dramatic change in the market's perception of what the terminal Fed funds rate should be. I mean, our view is that the Fed is going to wait for as long as they possibly can before they start cutting rates. But once they cut rates, the terminal Fed funds rate is probably going to be above 3.5% when it's all said and done. We'll just have to see how the data plays out.
We'll come back to that and its implications for the economy, but it's a different spin on that phrase, higher for longer, is basically what it is. Let me turn to Julia Coronado, if I might, and ask a question that I asked Steve a moment ago. It seems unlikely that the Federal Reserve statement, said Steve, will include any reference to the possibility of raising interest rates at this time to combat inflation. But it seems very likely, I think you would agree, that the chairman will be asked about that. What do you expect him to say? How will he dance on that head of a pin?
I think that what he'll say is that it's not something that they have discussed, and it's not something they think will be necessary at this point. That so far their strategy of holding rates at what they believe to be a restrictive level for a longer period of time is the right strategy. But at the end of the day, they'll follow the data. So he'll confirm data dependency, and he will also confirm their commitment to restoring price stability. So he's always very forceful and strong in saying, we'll do whatever the data dictate in terms of restoring price stability. But at this point, I think Chair Powell is not going to want to indicate any degree of panic given the firming in inflation in Q1. There are a lot of reasons to think that progress will resume as the year unfolds. So let the data deliver. If the data don't deliver that cooling trend as we move through Q2, then that conversation might shift. But one thing Chair Powell said coming out of the IMF meetings that really struck me in a world of global currencies that have been as volatile as they are, he said they understand well their job as keeper of the global reserve currency, and that their job is to be very transparent and communicate their thoughts and their approach as clearly as they can so as not to induce unnecessary volatility. We've seen a lot of volatility in the yen and currencies generally. The U.S., as the outperformer of the global economy, really sets us up as the safe haven for capital flows. So I think all of this says Chair Powell should be calm, cool, and collected, hold the line on the current strategy, but also their commitment to bringing inflation down over time.
Mike, let me turn to you with a question that is maybe sort of lurking off in the background a little more maybe than it should be, and that is the runoff of the Fed's balance sheet, quantitative tightening, if you will. What do you expect, if anything, for the Fed to say about that and for the pace of the reduction in the balance sheet, which is monetary tightening by another means?
Yeah, I think that's going to be the big question for today. I mean, what we're not expecting today are any major surprises. The focus will absolutely, as you said at the top of the hour, be on the rhetoric, on the language, and what that portends for the remainder of the year. The one point that we are watching, though, however, is that quantitative tightening. Do we start to taper that back a little bit? We think if that doesn't happen this month, it's probably in the cards in the near term. We've seen that this is a Fed chair that really likes to telegraph, to be transparent, and to get ahead of the trend. So I think that would obviously be positive news for the market if we do see that today. That's going to be the one material outcome that we're waiting for.
And you're of what view with respect to the number and magnitude of interest rate cuts this year, if any, Mike?
We've said all year long that this last mile is going to be choppy. And we are cautioning investors that you really have to, not read too much into what's in store for the remainder of the year. We're sticking to our guns with a 2.5% inflation target for the end of the year. We do think that the Fed will still have room to cut rates before the end of the year. Our base case, believe it or not, and I know this is outside consensus, but our base case is still at 325 basis point cuts before the end of the year, even as we sit today.